But China's had a little bit of a let's just say internal issue, and the president has sacked his top generals. Well, you're not going to create a storm with Taiwan if you've just fallen out with your generals. So that's put that back a bit, and that's what I see as what's put a damper on the price of gold and therefore silver. However, what I think I might have even said on your last show, that they would reconnect and that the trend of gold before it went vertical would reestablish itself. And that's exactly what's happened. So now gold is on a slow grind upwards because, funny enough, geopolitical stress is grinding upwards. So that is the story for gold, and gold is going to keep grinding on up. And silver, which is the FOMO gold, will be all over the place until further notice, and then may just go on another big run when gold goes above 6,000, as I feel it's likely to do.
A quiet storm may be forming beneath the surface of the precious metals market. Gold edges upward with steady determination while silver swings wildly, hinting at the possibility of an explosive move ahead. Market observers increasingly sense that the next chapter for precious metals could be driven not by sudden panic but by a slow build-up of geopolitical pressure and shifting global liquidity. According to Clem Chambers, founder of anewfn.com, the long-term narrative behind the gold rally remains rooted in geopolitical dynamics rather than short-term speculation. He suggests that gold's recent pause occurred partly because tensions surrounding Taiwan temporarily cooled. Internal developments in China reportedly led to leadership changes within the military, making it less likely that immediate confrontation would occur. When geopolitical risks pause, gold can lose some momentum. Chambers frequently describes gold as a strategic asset held primarily for wartime scenarios. Governments maintain reserves in central banks not merely for economic symbolism but as a form of financial insurance. In extreme geopolitical conditions where trust in paper currencies may decline, gold can act as universally accepted collateral. This perspective is reflected in the actions of several nations. Countries such as Poland have increased their gold holdings amid security concerns linked to their proximity to Russia. Similarly, China continues accumulating gold reserves while monitoring tensions around Taiwan. These patterns reinforce the idea that gold demand often rises alongside strategic uncertainty. Silver behaves differently. Chambers characterizes it as FOMO gold, meaning that it tends to surge after gold captures investor attention. While gold moves methodically, silver often reacts with far greater volatility. Investors who feel they missed the gold rally frequently turn to silver as a lower-priced alternative. If you're finding this analysis helpful, take a moment to like this video, subscribe to the channel, and hit the bell icon so you never miss timely updates.
I mean, my hypothesis, going all the way back on your show, calling that whole rise up.
Yeah.
Gold is for war. I keep saying it. Gold is for war. Now, silver is what I'm now calling it FOMO gold. Yeah, because gold is the one that drives everything, and gold is for war. That's why governments keep it in their central banks. It's not so that they can remonetize it, not so they can back their currency with it. It's so that if they get in a war, they can buy stuff they need, because people won't take their paper in a war. And that's why that's why Poland's finance minister's holding up gold bars. Being next door to Russia gives you a good reason to buy gold. That's why China's buying gold, even though they actually mine lots of it, because there's the Taiwan issue. Gold is for war, and countries have to lay gold in as geopolitical stress increases. And we've been seeing it increase. Now, it's taken a bit of a rest because the major war threat, which is out next year, is the Taiwan situation. But China's had a little bit of a let's just say, internal issue, and the president has sacked his top generals. Well, you're not going to create a storm with Taiwan if you've just fallen out with your generals. So that's put that back a bit. And that's what I see as what's put a damper on the price of gold and therefore silver. However, what I think I might have even said on your last show, that they would reconnect and that the trend of gold before it went vertical would reestablish itself. And that's exactly what's happened. So now gold is on a slow grind upwards because, funny enough, geopolitical stress is grinding upwards. So that is the story for gold, and gold is going to keep grinding on up. And silver, which is the FOMO gold, will be all over the place until further notice, and then may just go on another big run when gold goes above 6,000, as I feel it's likely to do. Well, gold is great collateral, of course, but literally, gold is for war. Why else do all this death of the dollar stuff? I mean, I get fed up with it. I mean, when is the dollar going to die? It keeps going up. I mean, you saw the Iranian situation, dollar goes up. So where's this death of the dollar? Where's this weak currency everybody's talking about as if it's going to fold? It's not real, is it? And they've been singing that same song ever since I was a child. Ever since, and that's 15 years ago. Sorry, joking apart, it's a long time they've been singing this song, and it's still not come about. And the dollar is still very strong. Just look at the chart of the euro. Just look at the chart of the pound. Just look at the chart of the yen. The dollar's very, very strong. It's too strong, actually. Yes, it's going to come down. Yes, it is on this way down, but it's still too strong, and it's still way strong. So why is there Fort Knox? Why is that all that gold kept there? It's a strategic reserve. For what? More silicon chips, or more dentistry, or more jewelry? Don't think so. It's a strategic reserve because it's the currency of war. And as the big military power, of course it has to have a strategic reserve of gold. And what does Britain, if money flows out of the market, it doesn't matter whether you're, a military company, it doesn't matter whether you're gold, it doesn't matter whether you're Bitcoin. People are putting cash out of risk assets and stashing it, waiting for the storm to clear. And that will pull prices down. Now, what then happens is the good old Fed and the Treasury in the US goes, oh, we can't have contagion here, and pulls the print lever button, whatever, prints money, flushes the system with cash like they keep doing, and up all the assets go. So really, it's not the news, it's the liquidity. If the Treasury and or the Fed thinks the system hasn't got enough money in it because of the way that people are parking it, it will flush money into the system, and up all the assets will go. And then when people come off the sidelines, it'll pull the money out of the system again, and it will stop going up. And that is the game of liquidity that is being played these days. And that is really the controlling factor. So really, if you want to trade it, which I don't, I'm just sat there waiting for in my positions. If you want to trade it, you just have to think about when people are going to be pulling money out of the system and when they're going to be pushing it in, because that's what is going to be driving prices for at least a few weeks from here.
This dynamic can cause sharp price swings and sudden rallies. In his view, silver may remain unpredictable in the near term but could experience a powerful run if gold eventually approaches the $6,000 level. The broader financial environment also plays a crucial role. Since the economic disruptions of the COVID-19 pandemic, enormous amounts of liquidity were injected into the global financial system. Central banks, particularly the Federal Reserve, expanded their balance sheets to stabilize markets and support economic activity. That flood of liquidity encouraged investment in riskier assets, including private credit and speculative ventures. When money is abundant, lenders often relax standards and allocate funds to increasingly questionable borrowers in search of higher yields. As monetary authorities gradually withdraw that liquidity, some of those weaker financial structures begin to collapse. Businesses that thrived on cheap borrowing suddenly face tighter conditions and higher financing costs. This process can trigger a chain reaction of defaults, resembling earlier credit cycles. Clem Chambers compares the current situation to the dynamics seen during the global financial crisis, when years of easy credit and aggressive lending fueled rapid expansion. Eventually, weak borrowers began defaulting, exposing fragile financial structures that the system could no longer sustain. Let's get back to the video.
I want to hang my head in sort of despair. There's 3,200 tons of gold mined every year. So that's 0.3% of the world's supply in the next 12 months. It's $100 million. I mean, that's like 4 rockets being fired, isn't it? So, it's not a material amount. And all it means is that rather than the gold going to Iran and Dubai and China for processing, because what they do is they dig out the gold from a mine, they concentrate it down, and they make these, not very pure gold bars, which they then sell to the refiners, who say, "Oh, I'll give you, $98 out of 100 for the pure gold in that." And they say, "Sure." So then the refiners make a few dollars refining it, a few percents refining it. So rather than having to go sneak out into dodgy places to do the refining, now it's going to the West like it should do, like South Africa sends its gold, and like anybody else that makes its gold, they dig it out of the mine, send it to a refiner, who then makes it into pure gold. And all that's happening is this gold is going out of Venezuela. It's not going to China or Iran or Dubai to be laundered. It's going to Transfiguro, isn't it? And they're going to, spruce it up and make it, delivery bar quality. So, all it means is something went right a little bit for all the parties involved. I mean, if you trace it all back, you can trace it back to COVID. And during COVID, they printed a vast ocean of money, and it was pushed into the economy to paper over that chasm of nobody doing any work. Okay, so all this money goes out, and then everybody's got fistful of monies in the financial world, and they want to find a place that can take that money and earn a yield on it. So you get situations like this where, private credit. Well, what's that then? Well, it's companies lending money to companies. Oh, well, where did they get the cash from? Well, the Fed pushed so much money into the system that it was sloshing around everywhere. Anybody that was creditable, anybody that could say, "Oh, I'm an investment bank, give me that cash, I'm going to, send it to the moon in a rocket," they would have got that cash. So they get that cash, and then the problem becomes, who can I give it to that's going to, A, give my money back, and B, give me a good yield? Well, funny enough, you run out of good people to give it to. And then you start giving it to less good people, and you start giving it to less good people, and then finally you give it to almost anybody with a credible story. And that is one of the big risks. That's what happened to Greensill in the UK. They couldn't find anybody to lend this money at a yield which was attractive. That was, a decent business. Oh, you'll lend me that money at 9%. Well, that's too much. I don't want it. Yeah, so you end up giving it to people that say, "Oh yeah, lend me money at 9%. Yeah, I have that. Have you got any more? Oh, I'll have that too. Oh, you got any more? I have that too. Oh, by the way, we've gone bust." Yeah, so that's the problem when you got too much liquidity. Now, what's happened was the Fed has pulled that liquidity in over a long period. If you go look at the balance sheet of the Fed and you look at the reverse repo, you can see that money being drained out. Well, as that tide of money goes out, all the sketchy people living off free money or easy to borrow money suddenly can't get it, and they go bust. And then you get a chain of defaults. And then those people that had this great business model when everybody was handing out cash to them to find a nice home for, start getting big defaults, just like happened in the credit crunch with the housing and the mortgages. Yeah, all those liars loans started to go sour. Well, that's what's happening here. But it's a much smaller market. And it's a market that, if it did horribly go wrong and it did start to create contagion, could easily be, basically bailed in and bailed out and bailed around and bailed about. So it's not of the scale of the housing crisis. So it's just going to cause a lot of headlines, and a lot of headlines will do.
Yeah.
Well, you gate it, don't you? And then you say, well, we're going to collect all the money we can, and then we're going to hand it back to you. So you get into a sort of voluntary liquidation situation. And that's what a lot of these funds are going to go into. And will people get all their money back? They'll probably get most of it back. So, it's just a end of an era for that kind of idea. Shadow banking, it's not got a great reputation. And this is what it is. It's shadow banking, all those banks doing it. It's an interesting model, and people keep trying it, but it always comes back to the fact that if you've got huge amounts of money to place, if you lower your standards, and that is basically what happens, everybody starts lowering their standards. They lower the standards, and to the people with the lowest standards start to go bust, and then the whole merry-go-round stops, and then even the good people can't do it anymore. And that's what will happen with this particular merry-go-round. It will come off its pivot, and it will be a X business, and it will have to restart at some other point in the future. Well, yes, but I think that the key thing is you look at direction. You look at the direction of the market, and then you look at the volatility. They're not the same. Yeah, all right, vast volatility can hurt direction because it can hurt valuations in the medium to long term. But in the short term, it's a matter of do you think the direction has changed in the long term, or do you think it's the same? And if it's the same, this is just a lot of shaking, and you just don't let yourself get shaken out. If you think the reason you're in your stocks or assets are still valid, well, why would you sell them? And that is the question. And I think right now we're going through a noisy period, and there's going to be a lot of shaking. And for traders, it's showtime, and they'll be making a lot of money if they're any good at that game. And for investors, it's just a matter of going, oh, because when it all kicked off, I lost that Monday more in one day than I've ever lost before. 4 days later, it was all back to where it was. And again, big loss this morning, big loss. Well, that loss is almost evaporated in a day. So, that underlines that this volatility is what it is, volatility. Don't let it shake you out of your long-term positions.
The interaction between liquidity and market psychology explains much of the current volatility across assets. Investors may temporarily pull money from markets and hold cash during uncertain periods, causing prices to fall even for fundamentally strong assets. Eventually, when policymakers perceive financial stress spreading through the system, they may reintroduce liquidity measures. When that happens, capital can rapidly return to markets, lifting prices once again. These cycles create an environment where short-term turbulence coexists with longer-term directional trends. Precious metals may experience sharp swings, yet underlying drivers such as geopolitical risk, monetary policy shifts, and structural debt pressures continue shaping the broader trajectory. Observers watching the gold market therefore focus less on daily fluctuations and more on whether those long-term forces are intensifying or fading. For investors trying to interpret these signals, the distinction between volatility and direction becomes critical. Markets can move violently in both directions while still maintaining a broader trend. Understanding whether current movements represent temporary turbulence or a genuine change in direction may determine how participants position themselves for the next phase of the precious metals cycle. Could the combination of rising geopolitical stress, tightening liquidity, and renewed monetary intervention eventually ignite the dramatic silver surge that some analysts anticipate once gold breaks through the next major threshold? If you found this breakdown helpful, don't forget to like, subscribe, and share it with others following the gold market. Thanks for watching. Stay informed, stay balanced, and I'll see you in the next video.